Hi everyone, this is Kate Otto with RE/MAX Alliance. I'm coming to you with another video today. Today we're lucky to have our loan partner, Christine Jensen, here with Fairway. I'm with my partner, Kim Bowman, as well. And we wanted to reach out again via video because we've been getting a lot of questions about how the loan market is changing and how the real estate market is changing in light of the shelter-in-place order that we've gotten. So we're gonna start by asking Christine, thanks for joining us, a few questions about how the market is going right now. The first question that I've been having personally as a consumer and that I've been getting from my clients is, what is driving the rates today? You know, what are the rates is often the question I get. So what is driving that today?
Yeah, that is one of the top questions that I get as well. And I'm really delighted to have this opportunity to bring some solid information to your group. So thanks for asking me to be with you today. But I have been originating mortgages for about 26 years now. I've got a few more years worth of experience prior to that. But for the last 26 years, we've been training our clients to watch the bond market in order to get an idea of where mortgage rates are going. However, though that dynamic has worked almost perfectly for us for the last 26 years, about 4 weeks ago, that entire dynamic changed. It started on March 9th. We had a significant drop off in rates, on prices, which meant upward pressure on rates. In fact, there was one day in the middle of March where we actually had a rate increase of 0.75%. We went from the mid threes to the low fours in a single day. It was one of the most striking things I had ever seen. And while the market continued to follow the bond market, that is, mortgage rates continued to mimic the bond market, that changed in the latter part of March. And what started transitioning, and it wasn't an overnight single event, but what started transitioning was the mortgage market went into kind of this twilight zone sort of territory where it wasn't behaving the way that it was behaving before. And the issue is liquidity. And let me explain what liquidity means in kind of a short answer, and then we can dig in as deeply as you like. But that is, when we were originating new mortgages out in the marketplace, that is, we got the honor of doing the financing for your clients that were purchasing homes. The way that a mortgage company works is, I get the honor of originating a mortgage for one of your clients so that they can purchase their home. And then I turn around and I sell that loan on the secondary market. And then that frees up the capital that I had invested so that I can turn around and loan it back out to the next client that you have for me the following week. Well, that dynamic worked perfectly up until a couple of weeks ago. And a couple of weeks ago, what started transitioning was we were originating new mortgages for you and fortunately the privilege of doing other clients as well. But they weren't getting purchased on the back end. They weren't getting bought on the secondary market. And what was happening on the backside is the secondary market was kind of calling a pause, a little timeout, and saying, wait a minute, things are changing too rapidly right now. The CARES Act kind of jumped into the market and sort of messing with the dynamics of how everything works. So we were having liquidity issues and we couldn't sell them on the secondary market. That was part of it. The other part of it that started impacting it was the announcement of forbearance options. And I know we're going to talk about that in greater detail in a moment. But then also the concern that if someone closed at, say, 4.25 or 4.5 on a 30-year fixed rate, the market began to fear that those folks are all going to be refinancing potentially later this year if rates do indeed and are starting to get already back into the mid to low threes. Mm-hmm. So that was the liquidity problems that we were having. Now, the good news is just over the past about week and a half or so, that's all starting to calm down a little bit, and liquidity is coming back into the market, but on a very limited basis. Sorry to dig in so deeply on the weeds like that, but I think that information helps to give a little bit more background.
Absolutely.
We appreciate that.
Yeah.
You've kind of touched on this, on how the mortgage market has shifted today, but is there any other shifts that you've seen other than the liquidity?
That's a really good question, Kim. So let me give you a couple of examples. Jumbo loans, which were so prevalent, that means any loan that's over 510, 400 in some markets, or 575,000 in other markets. So any loan amount that's greater than that is in our industry is referred to as a jumbo loan. We started to see a lot of scale back on the liquidity, that is the lack of purchasing those loans from us on the secondary market. We started seeing really limited buys on our other non-conforming products, which are like the stated income types of loans. Not that we originated too many of those in our office, but we started seeing a scaling back of other alternative loan types, like the renovation financing and things like that. And now this week, the trend has been to really tighten up on credit scores. You know, in the past, we were able to easily go down to as low as a 580 credit score. That crept up to a 620 and then a 640 and then a 660. This week, there were a number of investors that announced that they're not going to buy any loans with credit scores under 700. There's a few that we can still get access to that are going down to 680 and 670. But right now, our company is in a big push to get as many of those closed as we can, because if those continue to tighten up, that is the borrowers that have kind of those lower to middle tier credit scores, there's a possibility that those could be squeezed out of the market pretty soon as well. So just a couple of examples.
So I guess that kind of leads in really well to our next question is, how is this affecting qualification for a loan? It sounds like credit score has to be higher, obviously. Is there anything else that's changing as far as qualifying for an initial loan or a refi?
Yeah. I'm so glad you asked that question, Kate, because it's really important for your clients before they go out house hunting to not only make sure that they're going to be able to get approved for their financing, but we all have to kind of keep in mind that the dynamics in the market are changing rapidly right now. And if we had a client that had a, say, for example, a 685 credit score, when we start this conversation, not only are we going to look at what they qualify for today, but we're going to start talking about what steps they could do to make their credit score even stronger and even stronger. We're going to make sure that we've got really tight debt to income ratios. When we have clients that are really kind of pushing the upper limit on their debt to income ratio, we're going to have conversations about how do we make sure that we can kind of squeeze your debt to income ratio down a little bit? What are the other steps that we could be taking? Can we pay off some debt? Can we maybe look at a little bit lower price range? Can we talk about things like paying points to buy down your rate so that we can get your payment down? So I think this is one of those times where we're going to do what we've always done, which is ensure that people get pre-qualified and even pre-approved before they go out house hunting. But it's even more critical right now to do that, plus keep in the back of our mind that things could be changing. I'll tell you one other quick thing is that we are finding that there are some folks that got approved for their financing when their income was perfectly stable. But with all of the changes and transitions that employers are going through right now, some people are starting to see cutbacks in their hours, a reduction in the labor force, getting laid off completely, or being furloughed. And when that happens, that definitely impacts their loan approval right away.
So I know you don't have a crystal ball, but what do you think is going to change in the mortgage market this year with all of these things changing, and the rates getting driven by other factors and things like that? Do you have a good feeling of what might change?
Well, you're absolutely right. I would indeed love to have either the crystal ball, the magic 8-ball, or one of those. But I do think that there are some trends that we should be paying really close attention to. And the first one that's bringing me a little bit of encouragement is how the mortgage market has started to settle down a little bit over the last 2 weeks. We also have some really, really good conversations that are happening in Washington, are happening with our Federal Reserve Board of Governors and some others that really make me hopeful that the mortgage market is going to settle back down a little bit, get back into its groove. And there are a number of economists and others that are predicting that we're going to be in a fairly low interest rate environment the majority of this year. What that means for your buyers is once they see a rate that they really like, and right now I would say anything with a 3 in front of it is a great interest rate, especially when you look at the historical average. So if we can get to a day when rates get to where they want it to be, that they should indeed go ahead and grab and lock in that rate. Did that answer the question you were asking?
Thank you.
Okay, great.
Christine, I know you had some questions for us that you wanted to talk about.
Thanks. Yeah, because there's a lot of questions that I've been hearing from my clients, and I'll bet you're getting quite a bit of these as well. And the first question that I want to ask you is, how has home buying, excuse me, yeah, there it is. Sorry, looking at my notes. How has home buying changed a little bit or shifted in light of the stay-at-home order? I know there was a couple different orders from the governor in the state of Colorado, and then you guys have gotten some additional guidance from your trade association. So how are you navigating that in light of the stay-at-home order?
Yeah, it's definitely been a day-to-day situation, but the most recent stay-at-home order explicitly said that showings and open houses are not essential for home buying, which many buyers disagree with because they feel they need to be in the home before they can put an offer on the home. So we're getting creative. We've got virtual tours that are popping up much more frequently. We have a 3D rendition of the home that you can open closet doors and things like that. So the technology has been out there, we just haven't really used it because you could physically walk into the home. And then there's been a couple of people that have gotten really creative with linking sellers to potential buyers, getting a Zoom call together and the sellers walking the buyer through the house, opening doors and closets, going back to things that they want to see, answering questions. But yeah, so that's a very big change in the buying experience over here.
You know, I love hearing the innovation. Kate, what else?
Yeah.
Well, sorry, I was just going to say what I just wanted to add to that. Once they are under contract, it is essential. You can do your inspections and your walkthroughs, and title companies are really creative with the curbside closings. We've been a part of a few of those. All of the major title companies do that. So everything is just a little bit different.
Yeah. We're putting in offers, we're going under contract, and then the buyer can go in. And oftentimes, you know, it's conditional to move forward based on their walkthrough.
Gotcha. By the way, I want to invite your viewers to say hello to our branch operations manager who's in the background here. Since we've been under the stay-at-home order, we've moved our operations to our home office. So that's our branch operations manager, who's my husband, Dana.
Hello, how are you?
I'm heading out.
Okay, wear your mask.
Yep. So it sounds then, Kate, that people are actually buying and selling right now, yeah?
Yeah, we have quite a few under contract still, and you know, they're still very motivated buyers, and it's just a very different market. It's been interesting because we have a lot of inventory, a lot more inventory. We've had 1,100 units pulled from the market in the past couple of weeks. But we still have about 5,700 units on the market. It's the most we've had in a long time. We've typically been seeing somewhere around like 4,000 units month over month for, you know, just super, super tight inventory. And there are still really motivated buyers who want to be out there, want to be showing, and there's motivated sellers as well. You know, they have been planning to list and they want to list, and you know, we've just been kind of seeing not business as usual, it's business as unusual, but still a steady stream of people needing housing.
Well, that sounds encouraging.
Yeah, I think it is encouraging for sure.
Alrighty, Kim, now the big question. What do we think, what impact do we think this is all going to have on home values over the coming year?
Don't we all wish we could know for certain? No, so like Kate had said, there's been 11,000 that were pulled off the market, which is it's a higher number than we usually see. I think people are kind of pausing. Sorry?
All right, 1,100, not 11,000.
Did I say 11,000? I'm sorry, 1,100, which is more than what we usually see. But there's going to be a big influx, we think, of inventory once that stay-at-home order is completely lifted. People are ready to sell. We've been getting ready to sell. I have a friend that works for the photography company. They are very busy right now, photographing houses and getting people ready for when the stay-at-home order is lifted. So that inventory is going to go up. But with what you were saying, Christine, with some of the newer restrictions around mortgage and being qualified, we might see a lower buying population, which then, of course, supply and demand starts hitting some of the housing values. But our housing values have been the highest ever this month. So it might not be as big of an impact as we think, but that's what we're hoping anyway.
I think that really underscores the reason that your buyers need to stay and sellers need to stay really closely connected to you so that you can be giving them the most current and timely information and data that's out there.
Yeah.
Mm-hmm.
And it is, like we've talked about a lot, it is a day-to-day change of things. So it's been simple. Yeah, we're all just kind of getting with the groove every single day. So it is important that we know, what's happening, and we're here as a resource for everyone.
Good. Good.
Well, thank you so much, Christine, for joining us. It was really nice to see you in your home office. And Kim, it's good to see you in your home office. We're all adjusting. And if you need anything from us, we're a resource for you. We know that, a lot of us are going through furloughing and cutting salaries, and there's just a lot of emotion and there's a lot happening. So if we can be a resource to you, we absolutely are. And we're here to help. So thank you.
Thank you.